Okay, welcome to part 2 of the private reserve strategy. Now, in the last lesson, we talked a lot about concepts and terminology, but in this lesson, we're going to dive into where we're going to actually put this money that could be used as collateral that we could borrow against for our private reserve account. So, we are going to dissect the ideal characteristics of several different investments and savings options because it's extremely important that you pick the right place to put your money. The bank, where it's paying less than 1% on a savings account, might not be the ideal scenario. So where else could we put the money that we could use in this private reserve strategy? Well, what are some of the ideal characteristics? First of all, how about tax-deferred growth? That means that if your money grows and earns some interest, you don't have to pay capital gains tax on the growth of that money. We really got into details on taxes and taxable accounts back in the taxable accounts module. But you definitely, in an ideal scenario, want your money to grow tax deferred. How about tax-free distributions? Well, if you're creating a wish list, why wouldn't you want your money to be able to be tax-free when you access the money? When the money is distributed, you would like it to be tax-free, right? How about a competitive return? Now, obviously, rate of return is important. However, it's not the only thing to consider as we're going to look here. But most people, when they're choosing a place to put their money, the first thing they consider is the rate of return. I'm going to suggest that it's just one of many things to consider. Now, I also would suggest that you consider all of these ideal characteristics for where you're going to invest other money as well, not just money for this private reserve account. But we're going to come back to that in the future modules when we talk about how to apply a lot of these strategies to your situation. Obviously, you're going to need a place to put lots of different money, and you're going to want to always remember these ideal characteristics. How about high contributions? There are some investment vehicles that are limited on how much you can contribute every year. If we're creating a wish list, we want to be able to put in as much money as we want. How about deductible contributions? It would sure be nice to be able to put money somewhere that you could deduct that money off of your taxes. So one of the nice things about deductible contributions is that it saves you money in taxes, but what if that means that you don't get tax-free access to the money later on down the road? So you obviously in a perfect world would want all three of these, right? You would want tax-deferred growth, you would want tax-free access to the money, and you would want to deduct the money on your taxes. But obviously, we're going to have to pay taxes somewhere. But we're just creating an ideal scenario here. How about collateral opportunities? If your savings vehicle cannot be used as collateral, it will not work for the private reserve strategy. Okay? This is crucial. This is important. You have to be able to use the money as collateral. Okay? How about safe? What does safe mean? Well, it could mean it's safe from lawsuits, creditors, bankruptcies. Maybe it's in the bank where it's secured and insured by the FDIC, so that's safe. There's a lot of different ways that it could be considered safe. How about no loss provisions? Well, in Module 1, we learned that you don't want to lose your money because when you lose your money, you have to gain even more money to be able to make up for those losses, right? So we want to make sure that this money is not losing money, because if we have this account that's being used as collateral and all of a sudden that account drops in half, we might lose our collateral. Not a good position to be in. So we definitely don't want to lose money. How about guaranteed loan options? Have you ever had to qualify for a loan like a home equity loan, a mortgage loan, a car loan? It's a pain. I mean, sometimes it can take months to go through the underwriting process. Well, that's not going to work. If we have this major capital purchase and we need the money quickly, we want to be able to get to that money guaranteed. We don't want to have to qualify. We don't have to go through an application process or go through underwriting or go through a credit check or anything like that. How about unstructured loan payments? That's also really powerful. When we're borrowing this money, if we could pay it back on our own terms, right? So let's say we lost a job. How would you like to just not make a car payment or not make a mortgage payment if you didn't have income for a while? That would be nice. How would you like to only pay the interest for a while, if your income goes down? I mean, unstructured loan payments basically means you get to decide your payment terms. You get to decide when, how, or if you pay that money back. Now, of course, you have to pay it back eventually, But maybe it would just accrue interest. Maybe you don't even have to make monthly payments. Obviously, one option there. Liquidity, use, and control. You definitely want to have access to the money. That's crucial. You don't want to lock it up until you're 59 and a half or well into retirement years to where you can get to it. You want to have access to it. And then, of course, there's several other benefits that you might be thinking of, but these would be the majority of the benefits that you would want in choosing an account or the ideal characteristics of an account to use for the private reserve strategy. All right, while many accounts will work as a private reserve, there are some that work better than others. All right, so let's dissect each of these common accounts and see how they stack up with our list of benefits. Remember, this is our wish list over here. This is what we're going for. In a perfect world, we want all of these. All right, okay, so let's go ahead and choose some different accounts to see what kind of benefits they have. Let's start with the most common, which would be a savings account or a money market account. We're not going to be able to get a very competitive rate of return, right? You typically have money in a savings account, not for the rate of return. But you are going to be able to put in as much money as you want. You're going to be able to use the money as collateral in some situations because the money is there. It's safe. It's insured by the FDIC. It's guaranteed to never lose. It's not invested in the stock market where it's risky. And you have liquidity, use, and control of the money. Couple of things to consider. Interest rates tend to be relatively low. That's what you get with a savings account. Interest is taxed at ordinary income taxes. Now, even though the interest isn't much, whatever interest you are earning is also being taxed. It's like adding insult to injury, okay? Loans must still be negotiated with the bank with no guarantee or assurance that the loan will be made. So even if you have the money in your savings account, this sounds kind of funny, but you still have to qualify through the traditional underwriting process to get a loan from the bank or the financial institution, depending on who it is that you're borrowing the money from. But the bank is going to require that traditional loan application process. Call provisions normally included in loan covenants, meaning that they can actually ask for that money back at any time. If for whatever reason you have this loan outstanding with the bank, for whatever reason, if they want to, they can call that loan due and get that money back at any time, meaning you have to take your money that was in your account being used as collateral, you have to use that money to pay the bank back if they want that loan to be called, they call it, all right? All right, accounts are subject to creditor attachment, meaning that these accounts are subject to your credit rate as well as if you don't make a payment, you're going to have a negative credit because everything is tied to your creditor with these types of loans. All right. Liquidity from loans not assured unless credit line previously negotiated, subject to above mentioned provisions. All right. So nothing is guaranteed. You have to read the fine print and understand exactly how these loans work and what it takes to actually get to these loans and to borrow that money. All right. Now let's take a look at something that is similar, which would be a CD. So a CD or a certificate of deposit is going to have similar benefits as a savings account, not going to have as much liquidity, use, and control because when you get a CD, you are tying your money up for a certain time frame. So you don't have as much liquidity of the money. Interest rates also tend to be relatively low on a CD. The interest is also taxed as ordinary income. Loans must still be negotiated with the bank, just like the savings. Call provisions are normally included in the loan covenants, just like with the savings. Accounts are subject to creditor attachment, same. Liquidity from loans not assured unless credit line previously negotiated, subject to above mentioned provisions, and underlying principal tied up for a fixed period of time because it's a CD. So you can't access that money as collateral if it's in that time frame. If it's a 2-year CD or a 5-year CD, whatever the case may be, you're going to have your money tied up, not going to be quite as accessible. All right, how about, let's go to a margin account. What is a margin account? Well, a margin account would be if you have a stock portfolio. Let's say you have a bunch of money in some stocks with Fidelity. You can use that money as collateral, and you can get what we call a margin loan from your broker, which in this case would be Fidelity, the brokerage firm. Okay, so you're not going to, this is a taxable account, so refer back to the taxable account module. So you're not going to get tax deferred growth on the money. You're going to be paying capital gains taxes. You can't get to the money tax free. You are going to get a competitive return depending on the underlying investment. High contributions, you can put as much money as you want into a brokerage account. No real additional benefits there. Collateral opportunities. You are able to use your brokerage account as collateral, and you are able to borrow the money from the brokerage firm at whatever rate they are charging at the time. It's not safe. It's not guaranteed to never lose. You can get a loan. You are guaranteed to be able to get a loan. They do require a payment on those loans is the only downside to that, however. And it is liquid. You do have somewhat access to the money. Now let's look at some considerations. Amount available, typically half the value of the stock portfolio. The reason is because they know, like in 2008, the stock portfolios dropped in half. So if your money drops in half, you're going to lose collateral capacity, right? If you have money that you're using as collateral, but then all of a sudden that money is worth less, you're losing the collateral. So they're only going to let you use half of your money, typically, as collateral. One thing to consider. Amount available can change subject to the federal regulations. Decline in underlying stock portfolio could result in what we call a margin call. A margin call is where if your money is going down and the brokerage firm is worried that you're going to lose the collateral that that's securing the loan, they're going to call the loan due. In other words, they're going to say, pay up, we want you to pay back the loan. When that happens, a margin call requires a cash deposit or stock portfolio sale. That means that you may be selling at the worst possible time. You remember, you're supposed to buy low, sell high. But if the market crashes and you have the risk of losing your collateral, they're going to call that loan due. And if you don't have the cash to pay up, you've got to take the money out of your stock portfolio to pay that loan. And that could result in a capital gains tax, depending on the investments. So you may have to pay capital gains tax just to pay off that loan. And you might be selling at the worst possible time. Loan rates are typically tied to the LIBOR, which means that they're a variable rate. It's not going to be a fixed rate. It's going to vary depending on interest rates. Hedge fund shorting could trigger decline in the underlying security value and cause a margin call. If you're doing some fancy hedging and some options trading, you could risk triggering a margin call where that loan is going to come due. So lots of risks involved in using a margin account to be able to get a margin loan or a stock portfolio, but it can work. Okay, that's one option. All right, now what about a HELOC? Let's look at a real estate equity. So the equity in your house or another investment property, or what we would call a HELOC, a home equity line of credit. It could be a loan, it could be a line of credit, either one. Tax deferred growth on the money. When the value of your house goes up, you don't pay capital gains tax. Only when you sell the house, right? You're not going to get tax-free distributions because when you sell the house, you're going to pay capital gains. A competitive return, right? High contributions, additional benefits, none of which apply. Depending on what kind of real estate you're buying, you could get a decent return on the growth of that real estate, but it just depends. Collateral opportunities, definitely, and of course, none of these others. So some considerations. HELOCs must be granted by banks and are conditioned or conditional on creditworthiness and bank liquidity. Okay, so you have to qualify. I know people who have taken well over 3 months to be able to get a home equity line of credit loan approved because of the backlog, or everyone's trying to do it when interest rates are low, or whatever the information is that they require to get the loan through, all that kind of stuff. HELOCs may be revoked at any time at the discretion of the bank if no loans are outstanding. So maybe you have this line of credit using your house. You use your house to get this line of credit. You have $100,000 sitting there, and just on a whim, they decide they don't want you to have access to that $100,000 line of credit anymore, and voila, the money's gone, that loan is gone, you no longer, or not the loan, but the line of credit is gone at the discretion of the bank. It's totally up to them, okay? Most HELOCs have call provisions, meaning that they could, in the fine print, it says that they could require that loan to be paid up at any time. Given the fluctuation of the housing valuations, the amount of equity available for some borrowers could be insufficient for their needs. Meaning that if you have $100,000 of equity in your home, that doesn't mean that you're always going to have $100,000 available in equity, because it could fluctuate with the value of the market at the time. Also, they're going to have a cap on the amount of money that they're going to loan you. So they might only loan you up to 70% or even 80% of the value of your house, or of the equity. So if you have $100,000 in equity, they might only give you a $70,000 to $80,000 loan. Okay, they might only give you a percentage of what equity you have available. Okay, and last but not least, if you're not familiar with life insurance, this might throw you for a loop, but life insurance without question is the best vehicle to use for the private reserve strategy. Now, let me just say that I'm not here trying to convince you that the life insurance is the best investment all the time for everything, right? Maybe you have some investments that are doing a really good, that are getting a really good rate of return. Maybe the life insurance is only going to earn 6 to 8%. Now, you might be saying, how is it possible for life insurance to earn 6 to 8%? Well, it's possible, and we have lots of clients that are using this successfully and getting these 6 to 8% returns. Now, I can't guarantee anything because of, like they said, they always say past performance doesn't guarantee future performance, but it is possible in a life insurance vehicle, if done correctly, to get 6 to 8% returns without losing money, having it grow tax-free, and all these other benefits. But you cannot deduct the money going into the life insurance if you're going to want, tax-free distributions, and if you're going to want tax-deferred growth. Now, a couple other things to consider with life insurance. Riders are optional and may be available at additional costs. We typically do not recommend using riders because that just adds expenses. And the goal to making this work correctly is to keep the fees really, really low. That's not on here, but I would actually add low fees. Now, you might think, how's it possible to have low fees in a life insurance contract? It is possible. You just reduce the insurance because that's what the fees are tied to. So it's very, very possible. All right, once dividends are paid, they become guaranteed cash value, and cash value grows tax deferred. Loans are a contract feature. This is crucial. That means that in the contract, the loan is going to be specified. So you might be able to get a guaranteed loan option at 5%. Guaranteed. It might be in the contract. I know companies that offer a 5% guaranteed loan option. So it's not variable, right? It's fixed. So if you're earning 6 to 8% and you can borrow money at 5%, that's pretty cool. That works great as a private reserve account. Okay, loans reduce access to available cash value by the amount of the loan. Of course, if you take out a loan using your cash value as collateral, of course, that's going to reduce the amount of loans you could take in the future. Death benefit is paid income tax free and are reduced by outstanding loans or withdrawals. So in other words, you could borrow money, not pay back that money to the insurance company until you die. Then when you die, they could take the money that you owe them, or you could make payments to pay off the loan if you wanted to. It's up to you. Cash value deficit during initial capitalization funding period. What that means is that with life insurance, they typically don't give you access to all of your money in the beginning. So if you dropped in $10,000, you're not going to be able to borrow $10,000 in the first year. It's going to take a few years to build up the amount of money you can borrow. So if we were to use this, let's say for helping to pay for college, and you have a senior in high school and no money saved, you might need to use college loans to pay for college, then use this to pay back the college loans later, giving yourself a little bit of time to build up that collateral capacity. All right. How about disability waiver can pay premiums if insured is unable to work due to sickness or disability? That's pretty cool. That's what we would call an additional benefit right here, right? An additional benefit like a waiver that allows the premiums to be paid if you become disabled. So those are all some cool things, some cool benefits. And if you're not super familiar with life insurance, we've got another module that can go into a lot of this in more detail and help you to understand how life insurance can be used as a savings vehicle. But I want to talk about how this life insurance can be used as a private reserve account. So let's visually see how all this would work. So here we have our insurance company. Now, first of all, let me just point out that you don't have to borrow the money from the insurance company. That is just one option. Maybe you could borrow money somewhere else, like getting a 0% financing on a car loan or something like that. Maybe the banks have really low rates at the time. Or maybe you could pay a grandparent a 3% return instead of the 2% they're getting on their CD. So maybe you give them an IOU and you use your money as collateral to loan money from somebody else. Right? It could be any number of ways to borrow the money. But what I'm saying is that you could use the insurance as a place to borrow money. They're going to give you what we call an interest-only loan. Now, this is for any of our major capital purchases. We could do this to put an addition onto our home. We could use this to pay for college, buy a car. Now, interest rates have been low for a long time. Maybe by the time you're watching this, interest rates are high again. I don't think it's crazy to think that you could be paying 8% on a car loan. Well, maybe the insurance company would loan you money at 5%, maybe a better option. So this is just one option. But one of the best things about this is it's going to use your money as collateral, right? So your money is going to secure the loan from the insurance company, but remember, all of the money is still compounding interest, okay? Now, one of my favorite things about these loans from insurance companies is the non-structured payment. That means that if you don't make a payment, it doesn't affect your credit. If you don't want to make a payment, you don't have to make a payment. Non-structured payment means that you determine what the payment is. If you're earning 6 to 8% on your life insurance savings vehicle, cash value, if you're earning 6 to 8% on your cash value and you could get a interest-only loan at 5%, why would you make a payment? Why wouldn't you just put all of your extra money towards this earning 6 to 8%? You totally could. Okay, so non-structured payments that are going back to the insurance company. Now, permanent life insurance, when designed and utilized properly, can provide stable growth, cash value, collateralization, guaranteed loan access, no annual tax on growth and death benefits. Additional benefits are available with additional policy riders. Now, one more thing that I want to talk about. If I click on the use and control link here, we may not need to borrow money from the insurance company, and we may not need to use our money as collateral. It is just an option. If we are able to get a car loan at 0% financing or 2%, and they want to charge us 5%, we could get a car loan at 2% and leave our money available. However, we could use this as a backup. Let's say that we lost our job and we were unable to make that car payment. Then we could take out a loan from the insurance company to make that car payment for a few months while you were unemployed. So you don't have to borrow money from the insurance company. It's just another option. And it's using your money as collateral, but all of your money is growing uninterrupted. Now, like I said, if you've never heard of using life insurance this way, then I want to refer you to some of our future modules where we talk about leaving a legacy, and we really go into more detail on how life insurance works. Most people are only familiar with term insurance. Well, term insurance doesn't have any cash value. The only thing term insurance does is pay out a death benefit when the person dies. So there's really no what we call living benefits, right? So if you want to get living benefits, if you want to benefit from the life insurance while you're alive, then you need to have what we call permanent life insurance. But there's lots of different types of permanent life insurance. So we're going to dedicate an entire module to understanding all the different types of life insurance. So refer to that if this is something that interests you. Also, I'm going to run a couple of case studies to show you more specifically how this works. And always remember that you can reach out to us at any time to run numbers or to see scenarios for your situation. So thanks for watching this lesson. I hope that by now, between part 1 and part 2, you've been able to see how you can use this private reserve strategy for all your major capital purchases. One of the biggest purchases could even be your retirement. So yeah, you could even use this for retirement. Who would have ever thought about maybe borrowing the insurance company's money at 5% during retirement and allow your money to continue to compound interest during retirement? Or how to use this to pay for college and be able to earn more money more interest on your money than what it costs to borrow the money to pay for college. Lots of different ways you can use this. So get creative. Always keep this in mind as you consider your major capital purchases.